Ladies and gentlemen, welcome back to PwC's Risk and Regulation news channel. And today, welcome also to our first episode of the EBA stress test deep dive videos. Like always, I'm not doing this episode alone. I have today two guests with me. The first one is the EBA SSM Office co-lead, Benoit Sureau, from our PwC Paris office. Hi, Benoit, how are you?
Hi, Martin. Very well, thank you. We're having a great time here in Paris with the Olympic Games. Very happy to be with you today and to discuss the EBA Stress Test 2025 with you.
Yeah, thank you very much, Benoit. It's great to have you here on this video. And the great next expert that I would like to introduce is Ciaran Cunningham. He's the Workstream leader for capital management of our EBA SSM office. Hi, Ciaran. How are you?
Hi, Martin. Greetings from Ireland.
Ah, great. The first question goes into the direction of Benoit. Benoit, the EBA stress test is an exercise that is performed every 2 years. Maybe for those of our viewers who are not familiar with the stress test of the EBA, could you give us, please, a short overview about what the stress test actually is?
Yes, Martin, with pleasure. As you said, the stress test is a regulatory stress test. It is performed every 2 years since 2011 by the EBA. The main objective is to assess the resilience of the bank within the economic union. It covers the most significant bank, and this year it will cover 68 banks within the economic union and also in Norway. Regarding the methodology itself, the methodology is the same for all the banks, and they all use the same scenarios provided by the ESRB. The objective is really to allow for comparability between the different banks within Europe. Finally, the results are really important because first they will be published by the EBA and everybody will be able to look at the results and to evaluate by themselves the health of the different banks within Europe. Secondly, those results are used by the ECB during the SREP exercise and is also used to calculate the Pillar 2 guidance after the SREP exercise.
Thank you very much, Benoit. Extremely interesting. That means the EBA stress test is always a big challenge. But the stress test methodology for the stress test 2025 was just recently published in the beginning of July 2024. Ciaran, maybe one question into your direction because you're an absolute expert on that. What are the biggest challenges for the stress test in 2025?
Thanks, Martin. I suppose where to start? I mean, there are a number of challenges with respect to the 2025 stress test. And while there's a lot of overlap with the previous test in 2023, there are a number of new kind of reporting and calculation requirements. Most notably to call out is the introduction of COR3 and the implications of COR3 on the forecasted stressed RWA values to be used as part of the stress test, particularly from a credit risk perspective and for banks using the IRB approach. Having to forecast RWA under both IRB and standardised values for the purposes of calculating the output floor will be a significant step up in the requirements compared to 2023. Similarly, there are other more reporting requirements and more granular expectations in relation to reporting across the templates. And again, that's with the increased focus on data granularity by the ECB.
Ciaran, thank you very much for this first overview. Actually, the challenges are in several dimensions for the stress test 2025. There are some challenges on credit risk, on market risk, for NII, and some additional other challenges. Maybe to break it more down for our viewers, let's start with credit risk, because credit risk is always the most important type of risk for the banks. What are the biggest challenges with regard to credit risk?
It's probably a sensible starting point, Martin. Credit risk, the implications of credit risk are always the most significant when it comes to the EBA stress test. Maybe I'll split the kind of considerations down between the P&L and capital impacts and the capital requirements impacts, if that makes sense. Maybe starting with the approach to the determination of impairments under the stress test. It's fair to say that the approach to be taken in 2025 is very similar to the approach taken in the 2023 stress test. So banks will be required to stress their risk parameters under the baseline and adverse scenarios and translate those scenarios into impairment impacts and ultimately into impacts on profit and loss and on capital. Similar to the 2023 stress test, there are constraints embedded in the methodology most notably the inability to cure from stage 3 once you end up in there, so you can't come out of credit impaired. And also there's the inability to release accumulated provisions from stage 3 exposures. What is important to point out is maybe that the key impacts that come from the impairment methodology in the stress test is very much around items transitioning between the IFRS 9 stages. So from stage 1 to 2 or 3, or stage 2 to 3, or stage 1 to 2. And obviously the deteriorating lifetime PDs and LGDs that arise under the adverse scenario. What had been envisaged maybe at one point in terms of the 2025 stress test was a more explicit consideration in relation to ESG and capturing of climate risks. That hasn't manifested, but the requirement that was there in the 2023 to distribute losses over various sectors remains, and that was one of the significant challenges in the 2023 stress test and remains now. In addition, from a kind of an NPL reporting perspective, there are more onerous reporting requirements in relation to forbearance and forbearance activities. And we know that that's a kind of area of particular kind of focus from the ECB on on-site inspection at the moment across Europe. So from an impairment methodology perspective, very similar to 2023, but more implications coming down the line in terms of the scenarios when they're published by the ESRB and ECB. With respect to capital requirements from a credit risk perspective, that's where the game changer situation comes into play via the introduction of kind of CRR3 and the implications of CRR3. So what banks will be required to do under the 2025 stress test is to restate their December 2024 values on a CRR3 basis. So they'll need to reclassify their exposure classes, recalculate RWA, and potentially also move exposures between regulatory approaches, so between IRB and standardised, based on the new rules that are arising in CRR3. In addition to that, what further complicates matters is the requirement to project RWA on a CRR3 basis over the stress horizon. And this is particularly onerous for IRB banks, where they'll have to produce both standardised and IRB forecasts in order to calculate the impact of the output floor. But outside of the significant kind of data and reporting challenges that arise with respect to that, there are also impact challenges arising from the move to CRR3. As we've seen from benchmarking analysis that we've completed on our side and from our interaction with clients, it's fair to say the impact of CRR3 varies very much depending on the business model and balance sheet structure of the banks, as well as the kind of regulatory approaches they use, so whether they're more IRB or standardised or a combination of the two. But suffice to say, there are a number of areas within CRR3 where there can be adverse impacts and increases in RWA. Most notable call-outs there are probably the treatment of real estate exposures, the treatment of equity exposures, and also obviously clearly the impact of the output floor, which will need to be kind of forecast as part of the stress test also. So significant changes on the credit risk side.
Yeah, thank you very much, Ciaran. Wow, it's really a lot, both on the general credit risk side, but especially on the CR3 side, to calculate these CR3 figures, even when the reporting date, the first official reporting date, is in June 2025. Banks have to be able to calculate these stressed RWA much earlier. Luckily for market risk, I have heard the challenges are not so big, but of course there are still challenges. Maybe Ciaran, you can give us here a quick overview as well.
Sure, absolutely. There certainly are changes coming to light on foot of the market risk element as well, Martin. Maybe at a high level, maybe the general approach to the capturing market risk in the stress test is broadly aligned with the previous stress test, although there are some changes across various elements. In relation to kind of full revaluation, which is a kind of core part of the market risk stress, advanced banks that have large trading books, so that's defined as having FRTB RWA greater than 8% of total RWA, those banks are required to calculate additional kind of stresses on positions in their trading books that have optionality, so option instruments effectively. In addition, as part of full revaluation, there's also more granular reporting with respect to the treatment of hedge relationships. So very granular kind of disclosure in relation to cash flow hedges, fair value hedges, and splits between hedged items and hedged instruments. And there's also kind of comprehensive reporting in relation to kind of back-to-back transactions. In relation to the other element of the market risk stress, which is the kind of treatment of valuation reserves, one of the key changes there is the introduction of a stress for FVA, for funding valuation. And that's where banks have an FVA reserve in place as of 31 December 2024, and ultimately applying the market risk stress for the scenario to that FVA. In addition, in terms of valuation reserves, there's new requirements to calculate sensitivities for both CVA and FVA. So that's a new reporting obligation and something that the banks wouldn't have had to do in 2023. So kind of new data requirements arising from that also. There's another change in relation to the treatment of counterparty credit risk, where the 2023 stress test would have considered the stress with respect to the two most vulnerable counterparties. In 2025, that's extended to cover the three most vulnerable counterparties. So there should be an impact arising from that also. So there are the core changes with respect to the determination of the impact of market risk on P&L and on capital. With respect to capital requirements, there's some, inverted commas, relief, it's fair to say. So because of the extension of FRTB, the determination of capital requirements for the purposes of the market risk stress will follow CRR2. So the treatment that's in place at the end of December 2024 and consistent with the approach that's used to populate the COREP C91 templates. However, for CVA, which is captured as part of market risk, the obligation will be to forecast stressed CVA values on a CRR3 basis. So again, some significant change coming in there.
Thank you very much, Ciaran. We will make a separate deep dive video on the CRR3 changes and the impact on the EBA stress test as well, so we can refer to that. Maybe coming to NII, which was also always a challenge in the previous stress test, not so much from the methodology perspective, but from the data perspective, and because the expectations of the ECB and the EBA was always pretty different from what the banks calculated. So there were always a lot of discussions. Maybe regarding NII, you can give us also a quick overview. What are the biggest challenges? What are the changes that the banks have to consider? How do they have to prepare?
I suppose you're right, Martin, in saying that from a methodology perspective, probably no fundamental changes relative to the 2023 stress test. So some of the concerns that were there in the previous test remain in 2025. There has been some reaction by the ECB and the EBA to some of the feedback that was received as part of the last stress test, particularly in relation to the treatment of kind of derivatives that are held for trading and how they're treated in the context of the NII stress. So there was a revised treatment for those positions in 2025. Instead of having to project the reference rates and margins on those exposures, banks will be required to kind of take the last 3 years average accrued income on those trades and extrapolate that forward. So mechanically a little easier. The impact depends on, I suppose, how that historical performance has been relative to what the future outlook looks like. But that is a change to the scope of the exercise. Probably the key change arising this year is that the calculation will be performed kind of on a top-down basis by the ECB through its STAR portal. So banks will not have to actually produce the forecasts of reference rates and margins. The methodology will be the same, but the calculation effort will shift to the ECB. So while that does relieve some of the burden for institutions, there will be very much a focus on the quality of data that banks provide to the ECB for it to facilitate the calculations on its side. And to a certain extent, the banks lose some element of control over the inputs in terms of some of the modelling of margins and reference rates as well. So maybe a process relief, but mightn't necessarily give rise to a significant difference in the outcome of that. In addition to that, maybe a couple of other things to call out. There is new and enhanced reporting in relation to the treatment of matched funding positions. So that probably applies to certain business lines in certain territories, such as promotional loans. So that won't be across the board. But there are kind of enhanced reporting expectations there as well. So some new templates to be populated from an NII point of view. Obviously, a lot of the changes from NII come straight through into kind of PLN and capital. So there's nothing to call out from a capital requirements perspective. There isn't a Pillar 1 requirement for NII just yet, although we know there's a lot of activity in the marketplace in relation to IRB more broadly. So again, that's something that we're all keeping an eye on in terms of how the future might play out.
Great. Thank you very much, Ciaran, for the details on the NII. I assume that the point you mentioned regarding the top-down projections, done by the ECB now, that the banks have to give their calculations out of their hand. So the big challenge is, like you said, on the one hand side, the data quality for that. The results are also of good quality, but also the banks will be not in control of the results anymore, and that's going to be a big challenge, definitely. Yeah. Yeah, there are always some other changes, especially when we look to operational risk, and there are also some additional changes regarding the proportionality. Maybe very quickly, Ciaran, can you give us there a short overview as well?
Sure. On the operational risk side, again, probably the key call out is in relation to what was discussed earlier, so the introduction of CRR3 and the requirement to kind of calculate and restate December 2024 values on a CRR3 basis. So for banks using the various models to determine, or approaches to determine operational risk, then now be brought back to the single approach to be rolled out under CRR3 for the calculation of operational risk. That will also kind of serve as a floor for 2024 for the remainder of the exercise. Banks won't need to forecast that number, so the number that's there at 2024 on a restated basis will be the operational risk RWA number that will apply in the stress test. But there is still a kind of a challenge to calculating that number well ahead in advance of when it becomes formally reportable, similar to the other risk categories. Maybe the other item to call out, maybe more as a kind of a wrapper, is there is some allowance for proportionality, maybe across the stress test, for what are called smaller banks, so those banks with less than 50 billion of assets. In effect, how that applies is that the ECB or the EBA permits or provides certain materiality thresholds below which banks that fall into that category may not need to report certain items, or may need to, or they might have an alternative or more limited approach to the calculation of certain elements. So a bit of relief for smaller banks, but I think it's fair to say, Martin, given the significance of the changes elsewhere, that proportionality kind of change, is less impactful. I think that the key driver here across all the risk categories is the introduction of CRR3 and the interplay with the output floor, and having to project figures on a CRR3 basis well ahead of when those numbers are due to be reported in June of next year.
Yeah, great. Thank you very much, Ciaran. That was already a huge and very detailed overview about the challenges and the changes in the EBA stress test 2025. Maybe coming back to you, Benoit, listening to all these challenges that Ciaran just presented, what would be your advice? What should the banks do right now? How should they prepare for the stress test 2025?
Well, I would recommend to start now, based on the significant changes from a reporting and calculation perspective which has been introduced in this new stress test. Notably, the introduction of CRR3 and the restatement of the end of 2024 data may be a big challenge for the bank. So first, the bank should start with the analysis of the draft methodology and templates so that they can evaluate the main changes and also the new data requirement that they have to get for the stress test this year. Secondly, based on this analysis, I would recommend to get in touch with the CRR3 teams, if ever the teams are different, and to align the priorities. Because of this exercise, the bank have to be able to calculate RWA with the CRR3 hypothesis by the end of this year, which is quite tricky in comparison to the objective of June 2025. Finally, the bank should size the operational and IT needs to perform this stress test. Notably, they will have to review their calculation engine in order to take into account the new hypothesis and the CR3 requirement, and they will have also to take into account the new data requirement and the new template. So as you can see, Martin, the impact is important and banks really have to start now.
Yeah, thank you very much, Benoit. That was really a good advice. This is already the end of this video. There will be 4 more videos that we are going to publish in the next days. The next one will be on the CRR3 challenges, like how really to calculate the stressed RWA. Then there will be another video on the challenges regarding to credit risk. There will be one video with the special focus on market risk and NII. And last but not least, we have one video that cover the challenges like more from the organizational perspective and from the IT perspective, like how to structure a good stress test project and which tools should be used to calculate the stress test 2025. Thank you very much for your attention. Thank you very much, Ciaran. Thank you very much, Benoit. It was great to have you here and hope to see you soon. Bye-bye. Cheers.